Okay, everyone, we are now going to go over 10.2b and 10.3b, your practice problems for chapter 10. So I'm on page 390 of your book. On January 1, Manning Company purchases and installs a new machine costing $324,000. It has a 5-year life and an estimated $30,000 salvage value. So there's the three key things we need so far: cost, life, salvage value. Another way they define the life is in terms of how many units it will produce. It estimates that the useful life in terms of unit production is 1,470,000. It then goes on to report the actual units produced in each year. The machine cannot be depreciated below its estimated salvage value. We already know that, right? So they would like us to prepare a table with the following column headings and compute depreciation for each year for the machine under each depreciation method. So we're just giving you dollar amounts here, right? Let's focus first on straight line, that easiest method we have. We take the cost of the machine, $324,000, less the salvage value of $30,000. That's where they get the $294 from. So that's a formula, and here's what I'll even do. So we stay in line with what we've been talking about, right? 324 minus 30,000. That is how much of the machine you can expense over 5 years. Divide that by 5 years. So your straight line amount each year, $58,800. That does not change. The life doesn't change here. The salvage value did not change here. So we use the same amounts to calculate the expense for each year. If we add up the depreciation expense calculated for each year, under straight line, it will equal $294,000. Units of production, a different approach there. Remember, it is a two-step approach. Once you do the first step, it remains constant. Here, we take the cost of the machine, $324,000, minus the salvage value. That will give us $294,000. Instead of dividing the depreciable cost by the number of years you can use the machine, we're now going to divide it by the number of units it will produce over its life, 1,470,000 units. So each time a unit is produced, this machine depreciates 20 cents. So for each year, we must take the actual units produced times 20 cents. So year one, depreciation, 71,120. In the problem, they tell us in year two, the number of units were produced were 3,400. Multiply that by 20 cents. So if I keep track, so far, this machine has produced 355,600 in year one, and then 3,2,400 in year two. Okay, so that's at, give me a second, my calculator jazzed down on me. 355,600 plus 3,2,400. Now I'm jazzing out. 355,600 plus 3,2,400, 676,000 units. We said it's going to produce 1,470,000. The next year it produced 317,000. So multiply that by 20 cents per unit to get depreciation expense for year three, 63,400. So by the end of year three, this machine has produced 993,000 units. Now, year four's 343,600 is the actual units produced. times 20 cents. So we add that. So the machine has produced 1,336,600 units by the end of year 4. We multiply the actual units produced times 20 cents per unit to get depreciation expense for year 4. In year 5, the machine actually produced more than 138,500. I did something wrong somewhere. Oh, no, I didn't. It actually, sorry, I'm talking to myself. It actually produced more than 138,500. But we must stop calculating depreciation on this machine once it produces 1,470,000 units. So 1,470,000 minus the 1,336,600 units it's oh, sorry, just bear with me a second. I'm putting something in my computer wrong. My calculator here, and jazzing me and you up. Okay, there's that. Minus 1,470, 123. Why am I only getting 133,400? 355,600 the first year, 320,400 the second year, 317 the third year, 343,600 fourth year. It's going to produce a total of 1,470,000. So in year 5, sorry, bear with me a second. 355,600 minus 320,400. I'm just not seeing something, and that's not unusual. 343,600. I'm getting 133,400 as the actual. I'm double checking to what's in your book. So, oh, okay. Wait. All right. If you add the actual number of units it produced in year 5, it is right, is 138,500. But you can't just take 138,500 times 20 cents. Because if you use 138,500, it will cause you to expense more than 1,470,000 units. You can't do that. You can only expense the units till you reach the cumulative amount of the life, 1,470,000. So the actual number of units you can use to calculate, this is why I was getting jazzed up, is 133,400 times 20 cents gives you 26,680. So sorry about that. I was like, why do they have that 138,500? I can't be putting it in my calculator wrong all the time. But really, they should have put a little asterisk here and said, well, we can't use all that was produced. We could only use the remaining 133,400 because we have to stop calculating depreciation on this once we've reached 1,470,000 units. Sorry about that. Hopefully I didn't confuse you. Please make sure you're asking me any questions on that. So that's how we get the total amount for units of production. Overall, what do we expense? 294,000. But it's based on actual use or actual units made by the machine, where Straightline is just equal amounts every year. The final method, double declining balance. So let's take a look at that. Remember, that's a two-step process. The first is define a double declining balance rate, a DDB rate, I call it. How do we determine that? We take the straight line rate, which is 1/5 or 100% over 5. That'll give you 20%. Then multiply that by 2, double it, 40%. So every year you're going to use 40% to calculate that year's depreciation. Now, what do you multiply the 40% by? The beginning of that year's book value of the asset. Book value, remember, is cost less accumulated depreciation. In year one, the cost of this machine, $324,000, is its book value at the beginning of the year because there is no depreciation yet calculated. So for year one, you'll take cost times 40%. So year one's depreciation is $129,600. You'll debit depreciation expense and increase your accumulated depreciation by crediting it for the same amount. Now the book value of the asset at the end of year one is the cost minus the balance in accumulated depreciation, $194,400. To calculate year two's depreciation expense, use your new book value at the end of year one times 40% to give you $77,760. Sorry for these things popping up. Let's do this so we're out of there. When you record your journal entry at the end of year two, you will be crediting accumulated depreciation, increasing it to $207,360. You'll be crediting it for $77,760, adding it to the $129,600 credit already in the account. So now your book value at the end of year two will be the cost minus the new balance in depreciation, or $116,640. Going into year three, use your new book value times 40%. Your depreciation expense for year three, $46,656. So you'll debit depreciation expense, credit accumulated depreciation. Remember, when you credit that account, you're actually increasing it for the $46,656. So its new balance is $254,016. Subtract the new accumulated depreciation from the cost. The new book value at the end of year three, $69,984. Going into year four, new book value times 40% gives us depreciation expense for year four, and they rounded it to the nearest dollar. That will increase our accumulated depreciation now up to $282,010. Cost minus the accumulated depreciation gives us a book value of $41,990. We're getting close to our salvage value, and you remember, we can never allow the asset's book value to be less than salvage value. So if we took $41,990, year five's beginning book value, times 40%, our depreciation expense would be $16,796. If we recorded all of that and added it to our existing accumulated depreciation, our depreciation, accumulated depreciation balance would be $298,806. That would cause our book value to be $25,194. Not allowed. The lowest our book value can be is $30,000. So what do we do when our calculation will cause us to record too much in depreciation? We say, well, how much can we record? Well, our current book value is $41,990. What's the lowest it could be? $30,000. Subtract it. So we can record $11,990 of depreciation expense in that final year. That would cause our accumulated to now be at $294,000, which would cause our book value to equal salvage value. So here's our columns for our depreciation expense. We would transfer that up here. So you can see each year we are dramatically changing the amount of depreciation expense. Very high amount in the first year and second year. But then as the asset gets older, it goes down quite a bit. In the end, how much do we expense over 5 years? $294,000. So the method you pick will depend on how you want to affect net income. If you want to reel a lot of expense, use double declining balance. If you don't, use straight line. That's why most companies use straight line. It's very predictable and consistent. They don't want to upset net income too much. And that's what an expense does. All right, so let's go to 10.3b. Pretty straightforward kind of problem. But now they're going to test us on, hey, do you know how to do this stuff you talked about with figuring out the cost of an asset? So on January 1, ProTech Company pays a lump sum amount. Ooh, there it is. $1,550,000. What they buy? Land, building A, building B, and land improvements B. Building A has no value and will be demolished. Building B will be an office and is appraised at $482,800. It will also have a useful life of 15 years and a salvage value of $99,500. Land improvement B is valued at $142,000 today and is expected to last 5 years and have no salvage value. The land's value is $795,200. In addition, the company has some more expenditures related to this acquisition. So what we need to do is prepare a table with the columns you could see there: land, building B, building C, land improvement B, and land improvement C. The first thing we want to do is allocate the purchase price, that one fee we paid, $1,550,000, to the various assets we purchased. Now the land with the building that will be demolished is worth $795,200. Building B's fair value is $482,800. You could see this little table right here that I'm highlighting. The land improvements that were purchased in that lump sum purchase have a value, fair value of $142,000. So remember what this means. If you purchase these assets separately, that's how much you would have paid for each one of them, or a total of $1,420,000. Ooh, this is weird, huh? You actually paid $1,550,000. Oh well. Allocate the $1,550,000 you paid to each asset based on the percent each asset is of its total value, total fair value of all three assets. So $795,200 divided by $1,420,000 is 56%. So 56% of this acquisition is attributed to the land. So 56% of $1,550,000 should be debited to the land account, or $868,000. Building B, take the fair value of that divided by the total fair value of all three assets. You get 34%. So 34% of what was paid, $1,550,000, would be attributed to Building B. Building or land improvements slow down, right, Lori? Land improvements B has a fair value of $142,000. The total fair value of all three assets, $1,420,000. So that means 10% of the value is attributed to land improvements B. So 10% of the purchase price of $1,550,000 should be debited to land improvements B. So when we first start our chart, those are the amounts we want to put in land, building B, and land improvements B. Now, in addition, it says the cost to demolish building A is $122,000. Well, when we bought this land, we bought it with the intention of demolishing it to build another building. So we need to add the cost of demolition to the land account. Cost of additional land grading. Well, moving dirt around is part of the land cost. It is not a land improvement, not in accounting. Land improvements are assets put on or in the land that will deteriorate over time. This is just moving dirt around. Charge that cost to the land account. Cost to construct building C, $1,458,000. Well, that will go in building C's column. And then cost of new land improvements for land improvement C, $103,500. So part A or part one, we're determining the total cost of each of these assets. Once we determine the total cost, we will debit each asset for the determined amount and credit cash. Finally, they want us to use straight line method to prepare the December 31st adjusting entry to record depreciation for the first year these assets were in use. So the first thing I did was look to see, when did we buy these? January 1. Okay, then I can calculate a full year's depreciation. The next thing I want to know is land. Can I depreciate it? Nope. Building B, yes. So I want to know the life of building B, and it tells me it has a 15-year life and a $99,500 salvage value. So I will take the cost we just determined, $527, minus the salvage value, and divide that by 15 years. So building B's depreciation expense each year over the next 15 years, $28,500. I'm going to do the same thing with building C. Now on the top of page 391, they told me building C will have a $258,000 salvage value. So cost minus salvage value, and a 20-year life divided by 20. So $60,000 a year. So I'll debit depreciation expense, credit the accumulated depreciation for building C. Land improvements, B. They are expected to have a 5-year life and no salvage value. So we'll take their total cost we determined up here, $155,000, divided by 5 years, debit depreciation expense, credit the accumulated depreciation for land improvements B, $31,000. And finally, land improvements C at the top of page 391 have no salvage value and a 10-year life. So $10,350 will be the amount of depreciation each year that we will debit the expense and credit the accumulated depreciation account. So now we've seen bringing the assets in, how we allocate the cost and determine the total cost. If we buy more than one asset for one price, how we do the actual journal entry to record the purchase of the assets, and calculating and recording depreciation. So the other items we talked about, you'll be able to see in your practice assignments. So don't think, oh, she didn't go over them in the problems, so we're not responsible for them. No, there just wasn't problems associated with them. So you want to be familiar with all these different things we talked about in chapter 10 and post any questions you may have to the discussion board.